We finally have some good news. Inflation in the US has fallen to 8.5%. It is not really great news, even though it is lower than previous month's 9.1%, but that's still a lot. In fact, at this rate, the economy can't function properly, thanks to the chairman of the Fed, Jay Powell, who kept telling us that inflation is not an issue and kept printing trillions of dollars. Look at this chart. Inflation kept climbing month after month. The Fed knew for sure that we are going to have massive inflation, but decided to keep the public in the dark. Of course, they had a good reason to do that. We had a virus that was spreading across the globe. We could not risk letting people get back to work, so we printed trillions of dollars. But the moment Russia invaded Ukraine, the virus somehow disappeared and we no longer print trillions of dollars. Look at the number of cases. Before the invasion, there was a huge spike right before the invasion, and the number of cases dropped significantly. People are back to work and we no longer are worried about the pandemic as if it is just another disease like the flu. I'm not a conspiracy theorist or a supporter of Trump, but they've made such a big deal out of Trump when he treated COVID like the flu. If the government decided to open the country and get the economy back to work instead of printing trillions of dollars, we certainly wouldn't have such a huge inflation in the first place. Regardless of what happened, it is what it is. So the question we should be focusing on is, how do you profit from inflation? We have to adapt to the circumstances and learn how to profit from this crisis. There are millions of opinions and millions of experts on the internet, but I suggest we take the advice of the greatest investor of all time, Warren Buffett. This is not the first time the country has been going through a crisis, and definitely not the last. Warren Buffett is almost a century old, so he has been in multiple inflationary periods. So let's find out Warren Buffett's strategy to make millions of dollars when there is a huge inflation. If you're ready, give this video a thumbs up and let's get right into it. Warren Buffett's first most important advice is be exceptionally good at something. That doesn't sound like a piece of advice you'd like to hear. You probably expected something like invest in this company or buy that stock. But the truth is that most people don't have the kind of money that they could invest and comfortably watch how millions or even at least hundreds of thousands of dollars would fill their bank accounts. But here's what most people are usually good at: trading their time for money. It is what we have been taught since primary school. That's of course not the best way to make money, since your time is limited. But your time is the only thing that you have absolute control over, and no one can take it away. So the best way to hedge yourself against inflation is by investing in yourself and being exceptional at something, be it a doctor, engineer, teaching, whatever. Because no matter what crisis we're going through, even if it's inflationary, the demand for basic skills will always be there. People aren't just going to stop visiting doctors just because it is more expensive. People will visit doctors regardless of the price. And during high inflation, people with skills can raise their prices easily without affecting the demand much. The only problem is that you should do this way before inflation hits. Which means it's a bit late now, since inflation has been around for over a year now and reached almost double digits last few months. So if you want to be ready for the next inflation, think about investing in yourself, in your skills, and being the master of your craft. Be the best surgeon, the best teacher, or the best lawyer. If you have done that, here is what Warren Buffett suggests next. According to him, the second best protection is a wonderful business, which means a company in which the products are in demand even if the company does have to raise prices. No matter how badly we hate inflation, it is just part of the economic cycle. It is going to happen regardless of whether you like it or not. Another fact is that not all businesses are going to survive. A lot of businesses are going to suffer when they start raising prices, and if they don't, their profits will shrink since the cost of their products or services is going to rise due to inflation. So, what are the businesses that can withstand inflation? In a 1981 letter to shareholders, Buffett possibly spelled this all out as clearly as ever, writing that companies that tend to withstand an inflationary environment must have two characteristics. Number one, an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And secondly, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investments of capital. He's basically saying that if a business is selling a necessity like bread, it can increase its prices and people will keep buying the bread. It is not going to change anything. Secondly, the business doesn't need extra huge capital investment to grow or adjust to the circumstances. For example, if it's a railway business, it takes massive initial capital to build the railway. However, if it's an online business, serving an extra client isn't going to cost anything, like the App Store, for example. An extra user is not going to cost Apple anything. Even an extra million user isn't going to require Apple to make any significant investment in the App Store to manage it. So, what are the companies that Buffett invested in during the current inflation? Buffett did not reveal everything he bought, but did mention several highlights, including boosting Berkshire's stake in oil giant Chevron to $26 billion, up from $4.5 billion at the beginning of the year, to make it one of the conglomerate's 4 biggest investments. Berkshire also spent billions buying up 14% of Occidental Petroleum shares in the first half of March and added its already massive investment in Apple stock. Oil prices are rising due to reasons we have explored previously, and people aren't going to stop using oil. The demand will keep only rising regardless of the price. What is going to happen at the end of the day is that the increase in oil prices will just influence everything else. The businesses will pass that cost to consumers. Secondly, Apple is the type of company that has turned technology into a necessity. Just because we are going through such a huge crisis, it doesn't mean people will stop buying iPhones or MacBooks. iPhones are an essential part of the global economy. People have built entire businesses around them. People might stop buying cars, but not iPhones or MacBooks. They're not going to get rid of their Apple subscriptions. This is the new reality that they have built. And that's why, despite the fact that Buffett avoids tech companies, he gladly invests in Apple, and his investments have paid off very well. But even if you have this information in your hands, you still can't do much about it. What are the chances that you can pick a great company? Even though these are important characteristics, you still have to go through their financial statements to make sure that they have enough liquidity, they're not drowning in debt, they have great profit margins, they are not one step away from bankruptcy, the management is wise enough, and the company has a visionary board. I mean, these are all indicators that you look at to make sure that the company you're investing in is a great investment. But most people aren't capable of doing that. It is not an insult, it is just a fact because people are busy mastering their own craft. Most people simply don't have the time to master the art of investing. That's why Buffett has an advice for everyone. I do not think the average person can pick stocks and recommends the S&P 500 index fund to have for a long time to people. We have enough data to believe that over the long run, the S&P 500 has made great returns. It has outperformed most of the hedge funds and proved to be a great hedge against inflation. But you have to be patient, because over the short run, sometimes the S&P 500 has done pretty bad. But over the long run, at least 10 years if not longer, the index has proved to return around 10% annually. So, if you're not into stocks, or you think you're a better investor than Warren Buffett when in reality your portfolio is significantly down after Fed's rate hikes, you're much better off in listening to Warren Buffett and just throwing your money into an index fund. To be honest, despite the fact that I pick individual stocks after analyzing them carefully, I still follow this advice. A big chunk of my investments are in index funds, primarily in the Vanguard S&P 500. It's actually up by at least 15% since its bottom line back in June. That's it for today, thanks for watching and see you in the next one.